Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Reminder, we are still doing our swag giveaway. It's super easy. All you have to do is subscribe and comment wherever you are listening. I'm loving the comments so far, and one lucky person each episode will be selected to get exclusive access to our swag store. On this episode, we've got Josh Young of Bison Interests. He's really interesting. He's an American investor based in Houston, but he loves his Canadian energy stocks. We talk about why that is, even at current oil prices. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. We all want to make the most of our investments. That's why BMO Investor Line is here. Their easy-to-use platform packed with tools, resources, and commission-free trading on over 100 popular ETFs can help you trade with confidence and take control of your financial future. Start investing today with bmo.com/investorline. Josh Young, thank you so much for joining us on the podcast.
Thanks for having me.
So you and I have never spoken before. And I know kind of two things about you. You're very prolific on Twitter. You have over 100,000 followers. So there's a lot of people who care about what you have to say about energy. And I know you're based in Houston, and you seem to have a little soft spot for Canadian energy producers in particular. So why don't you start first by kind of introducing or reintroducing yourself to this Canadian audience?
Sure. Yeah. Thanks again for having me. And yeah, you might notice the Canadian for it is toque, the warm winter hat with the I Heart Canadian Oil on the background, which I received a number of years ago from a group that advocates for Canadian oil and gas. So I run Bison Interests, which is an investment advisor that advises an investment fund that invests in publicly traded oil and gas companies. And we launched in 2015. And since that time, we've had intermittent overweight either towards Canadian oil and gas companies or US. And there have been periods of time where most of our assets under management have been deployed into Canadian publicly traded oil and gas producers. So part of the logic on that is that there are some times where there are big valuation discrepancies where you can buy similar producers in Canada, for example, at much lower valuations, or in the US for much lower valuations. And so since we're very value focused and we have a view that buying things at a large discount to their intrinsic value offers a big margin of safety as well as potentially extra upside over time, we'll sort of go where the valuations tell us to go.
So what are Canadian energy valuations right now relative to your history in the markets? Does it warrant that more overweight positioning that you've had in the past?
So right now is sort of a complicated and weird bifurcation in the market that's actually driven much less by geography and much more by market capitalization. And we've always leaned towards the sort of small to mid cap side of the market because there have been better values throughout the down cycle that we've been investing since essentially 2015. But that difference has gotten pretty extreme to the point where it almost matters less from a value perspective whether a company is in the US or Canada, and more whether it's at, let's say, a $2 or $3 billion valuation, market cap or higher, or below that, where the lower you get, the lower valuation you get for often very similar or the same type of assets, in some cases literally the same, where you have a small non-op working interest in a larger company, and the larger company be at like 7 times EBITDA and the smaller ones at 2 times for the same assets. And so right now it looks like the bigger difference is that is not the cross-border difference, it's a size difference. At the large size, the large producers in the US look pretty similar more or less to the large producers in Canada from a valuation perspective.
So it's interesting, Josh, when you talk about those smaller companies around 2 billion and below, I mean, that's a sector that has a tendency to be orphaned and maybe can experience those larger valuation gaps And I wonder, how much risk tolerance do you have to have? Like, do you just need to be prepared to stomach a couple of 10% pullbacks in a short period of time in order to see long-term gains?
So we named our firm Bison because the bison, at least from a U.S. perspective, are the animals that face into the storm and get through it safer and faster. So safer in this case is not mitigating short-term volatility. Frankly, 10% moves are a normal day or week or month for small cap public equities, even outside of the oil and gas space. Yeah, I think there is a lot more risk in the smaller cap companies, both in terms of short-term price volatility as well as in potential insolvency. And so it does make sense that there would be some discount. But what we found is when we look similar to the analysis on the cross-border shifting based on valuation, there's a cyclical tendency for the smaller caps to trade to very low valuations towards the bottom of cycles and to actually quite high valuations towards the top of cycles. If you think about it just very high level, oil is produced when companies go drill for it and then produce it. And there's a lot of exploration and other stuff that goes into it, but it's just sort of basic and there's some lag. And so when prices are high, there's a big incentive to go drill a lot. And the companies that are able to respond fastest typically are the smallest. And so at the tops of cycles at high prices, those companies trade at really high valuations. And then when there's not that incentive to do that, those companies typically are the highest cost producers by and large. And so they'll actually trade at the lowest valuations. There's no market impetus to go drill and grow. So we're really interested in owning these things at low valuations, at low parts of the cycle when everyone sort of hates them and is bearish on oil and doesn't see a lot of optimism for the sector as well as for these companies. And then to sell them when the opposite is true and when everyone's really excited about them. So there's a cyclical aspect to it that makes these, I think, really exciting and really logical, but also extremely risky and extremely volatile.
So we're seeing players step in. It might not be investors or private equity, but we've started to see a lot of M&A. And don't worry, we're going to name names and we're going to talk about specific cases that are going on. But Josh, at a high level, how much M&A do you expect in the sector? Is this germane to your thesis around these stocks, or is that just kind of a cherry on top?
Yeah, so we don't depend on our investments on M&A to realize value. I think it's just a thing that you should expect in across companies, but particularly in cyclicals. And I mean, one of the things that happens when you have the sort of mergers and acquisitions that we've been seeing is you have a reduced supply of oil and gas producer stocks. And so especially on the smaller and mid cap side. And so when you do have money come back into the space, there are fewer options and there's smaller market capitalizations. And so there's actually room across the remaining small and mid cap companies for much bigger share price improvements. And we did see this in past cycles. I think it's also a very sort of weird phenomenon where you see asset allocators from the financial world pulling money out, particularly out of oil, less so out of natural gas. And at the same time, you have some of the best companies, most brilliant management teams, best performing track record, larger companies going and aggressively deploying into buying more assets and companies in that same space that these brilliant allocators and endowments and pension funds and family offices and stuff are aggressively selling. And so, I think it's a very interesting dynamic. And I think the brilliant large company allocators with great decades of experience are probably right. And to me, it's just very exciting, but not necessarily the thing that's I think it helps us know that our sails are pointed in the right direction, or I guess our snouts as bisons, but I don't know that it's necessary for the thesis to work.
So those funds, they're backing out, presumably why? Because of, philosophical reasons around, environmental investments. There certainly was a movement away from the energy sector because of that. I wonder if it could come back because people seem to be going the other way with it. Certainly, with DEI initiatives. we haven't seen that actually come back in a major way when it comes to environmental initiatives. Do you think they come back? Do they need to come back in order for the thesis to pan out?
So we are actually seeing some money start to come back. The fundraisings on the private equity side for oil and gas last year, I heard a statistic at a conference recently that just last year there was more money raised in oil and gas private equity than in the prior 6 years combined. So there is institutional money starting to come back. But not on the public side yet. There's still on the public side a lot of divestitures. And then at the same time, you're seeing these smart allocators going and buying public companies and buying these oil assets. So there is a divergence, but we are seeing money start to come back. And a lot of that money is from groups that have ESG mandates and have DEI programs and so on. So I think at the end, really what's driving this is return chasing. And so I think that as there are better returns, which I think will be driven cyclically, it's not really about investor demand as much as it is about undersupply of oil and better economics. And as you get better economics and rational capital allocation, you get into that sort of tighter market scenario, the money chases the returns. And so we almost got that in 2022, and then we've had a big pullback since then. And I think as the cycle, it was almost premature in 22, there wasn't really enough supply destruction and demand increase, and the amount of supply destruction wasn't sort of permanent enough. As the cycle progresses, you see returns get extraordinary, and then you see a lot of capital flow in.
So I'm going to ask you such a Canadian question, Canadian question to an American, which is, what do you think of our political landscape? You know, Canadians are always asking Americans, what do you think of what we're doing up here? I won't pretend that the whole country cares about our politics, but as an energy investor focused in Canada, I'm sure you've got a thought or you've had discussions around what Mark Carney as a prime minister means for the sector, because maybe on the surface of it, you know, he is big on environment and sustainability, but he's also talking about making Canada an energy superpower, pushing through pipelines.
So I would say that the recent experience in the US means that we should stay quite humble, and that those who live in glass houses should not throw stones. And so, I think policy has been disappointing here in the US for many years, and it's been disappointing in Canada for a number of years. And I'm optimistic. It's possible Carney will follow through on some of his election promises. But as we see the American president fail to follow through on some of his election promises, I think it makes sense to remain skeptical and cautious. But again, I think it's just an issue broadly that politicians will do what they see as in their personal best interests, unfortunately, over what's in the best interest of their constituents or their countries. And so I think it makes sense to be skeptical and cautious, cross-border and broadly globally.
So we got politics you got to consider with every company. You've got sort of structural health of the companies that you also have to consider in valuations. We obviously have to talk about the oil price, which has done very poorly over the last year. And we're talking about it at an interesting time where OPEC Plus has increased production now for a third month. So there's more supply coming online at a time where we're worried about growth and demand for that oil. So that's like economics 101, right? More supply and less demand equals lower prices. But pretty much every interview that I've seen you on, Josh, you talk about higher oil prices, $80, sometimes $100. What is your target for oil prices now?
So I think the fair value right now, based on where observable inventories sit, and there's some debate over that, and different high frequency data providers are in conflict with each other, and I'll let them battle that out. But based on sort of just the consensus, let's say EIA numbers, I'll avoid IEA just because they keep having this missing barrels issue. it shows like a pretty interesting market and pretty interesting inventory level. And so just based on the standard comparative inventory analysis that shows correlation between price and inventories over time, you would think WTI oil should be around $85 a barrel today. Excluding any sort of forward view, or are we going to go into a supply deficit or surplus? I think that sort of 85 number, plus or minus $5 a barrel or so, is just in line with that comparative inventory analysis and statistical analysis that many different firms do. And then they'll apply their sort of lens of market analysis on top of that. And so when I apply my lens on top of that and what the work we do at Bison, we see the market moving towards significant undersupply. And when you undershoot by as much as we have, we think there's a risk that we end up overshooting. So when does that happen? I don't know. But the more oil prices undershoot versus their fair value, and the longer that happens, the more likely it is that prices rise way above where they should, and the longer they're likely to stay there, just to induce that investment that we were talking about earlier, to get the valuations of the companies that would be doing those investments high enough and get enough capital into them to actually fund those investments. And that's what we've seen in every oil cycle. There's been 30 or so oil cycles since oil has been a commercial commodity in the last 150 years. And so this isn't the first time. This time is likely not different. And so right now, oil should probably be $80 to $90 a barrel, and depending on what happens with tariffs and various other demand concerns and other issues, I think you could end up seeing prices resolve much higher than that current fair price.
What's your time horizon for that? Because I'm like, I could go through a laundry list of other factors that could weigh on oil prices. You've made it clear that that's the one factor you're looking at for oil prices to go higher. But what's your time horizon?
Yeah, I mean, I think it's hard to say, because once you get, and that may not be very satisfying, but once you get prices untethered from fundamentals, I think it's really just speculation in terms of what the specific catalyst is to retether prices to fundamentals, or to slingshot them from too low versus their fundamentals to too high versus their fundamentals. So honestly, I don't know. I'm not sure anyone really knows. And I would just observe more the capital cycle aspect of the oil market rather than some of the sort of, it's fun to talk about the more speculative stuff. And hey, is OPEC going to increase supplies by a little bit, or is supply going to disappoint in X, Y, or Z region? But there's sort of a reality for this, which is there is a fair price and there is a discount currently. And historically, when you invest in equities in oil and gas at a discount like that, and at low valuations for the companies, even at that discounted commodity price, there's been excess returns across the numerous cycles that the oil and gas industry has experienced over 150 years. So again, like, is it this month or is it even this year? I don't know. But I think it should be higher, but what will actually get it higher, we'll see. But eventually, I think you end up, the cure for low prices is low prices. We're firmly in that low price scenario. The rig count's been falling, completions have been falling, and that's a great setup for much higher prices.
So is that kind of a short-term win for the Saudis and OPEC? Because we're trying to make sense. Why is OPEC cutting when prices, why is OPEC flooding the market with more supply when prices are falling? They would love $85 per barrel, right? And every time they increase production, prices ultimately fall lower. And there was an analyst at Desjardins who said, if it looks like a price war, walks like a price war, and quacks like a price war, then it's probably a price war. That the Saudis are doing this, OPEC is doing this in order to, I guess, squeeze out the weak hands and gain some market share. I guess the question is, like, can they do this for a really long time? And how much pain will energy investors have to endure?
Yeah, so even though I have two OPEC logos from recently visiting Vienna and hanging out with the Secretary General and some of the other OPEC folks, I'm not sponsored by them, and I won't speak for them. But I can observe that what they've done so far with their alleged production increases has not been to increase their exports. And so I would observe that there's another thing back there, which is a picture of Warren Buffett. And he says that you should ignore what people say and focus entirely on what they do. And what OPEC has done so far has not been to flood the market. They flooded the market with paper barrels, but they have not yet flooded the market with real barrels. And if you look at the OPEC plus conundrum, where you had three different countries cheating to a large extent, and at least one of them, Kazakhstan, refusing to cut their production in line with their commitments, it should not be a surprise that they would increase at least their bring back some voluntary cuts. The reality is that the market was undersupplied. I talked about this earlier this year and people thought I was nuts. And then now you look back at the data and it shows that that was valid. Q1, the oil market was undersupplied by over 1 million barrels a day. And so what will the future hold? I don't know. But if you just have OPEC bring back the actual 1 million barrels a day that was missing in Q1, you would get closer to a balanced market, which would call, again, you back to the fundamentals of, let's say, $85 a barrel or so. And I don't think anyone really knows what's going to happen with US tariffs or the global economy or a trade war or anything like that, and how that gets offset by money printing and various other concerns, as well as just the normal roughly 1 million barrel a day demand growth globally versus supply that may or may not grow by that, especially at current low oil prices. So again, lots of different complicated factors, but there's a reality, which is the oil market was undersupplied, and OPEC has not yet actually fixed that, even though they've increased the number of paper barrels by a lot.
That's great perspective, and I think speaks to a lot of the global influences. I want to bring it back home to Canada before we talk about some of these stocks. And something that's happening with Canadian energy prices right now, yes, we're lower because, global prices are lower, but the discount on Canadian energy prices is narrowing. And it's, as of right now, June 2nd, is the narrowest that it's been in 2 years. Part of that has to do with wildfires that are raging, shuttering some production, putting, hundreds of thousands of barrels at risk, which is maybe a large percentage for the Canadian markets. And if it grows, I don't know, at some point do global markets pay attention? But these wildfires are becoming a more frequent thing that investors need to think about. How do you as an investor think about the wildfires?
Well, so far in the last number of years, what have looked like wildfires have actually been arson for the most part. And so hopefully that isn't what happened. But my observation, I think it goes back to these sort of failing politics and policies. Arsonists should be investigated and prosecuted, and potential arson should be investigated too, because again, the people die from this stuff, and it's really bad beyond just the oil and gas industry. It's not a Canadian specific issue that's happened in the U.S. Across a number of states too. So there's the high level sort of politics policy, which is just, it's a bad policy to not strictly enforce the laws around arson, and the governments should be much more proactive in terms of that. In terms of the supply risk, so the specifics for the Canadian producers, the reality is it's not like their fields get destroyed by and large by these fires. It's just that there are temporary supply disruptions, and those help mitigate price discounts or increase local prices for short periods of time. It may even have an impact on the global oil market for a very short period. But by and large, these things are temporary. The market is able to look through them. Again, while I think that the oil market is overly discounting the price of oil versus fundamentals currently, it's still pretty good at looking through temporary disruptions or temporary surpluses, like we see again with hurricanes here in the Gulf Coast, and then wildfires in Canada and various other issues that unfortunately are recurring. I just don't know that they matter that much. They matter, again, a lot for the local people. And, I hope that they're cut back a lot. And unfortunately, a lot of them in retrospect look like they were arson, not wild. And so hopefully that gets addressed. But for the companies, if they get their production cut off for a day, a week, a month, for the most part, it doesn't actually really matter. And they're able to, in some cases, have stored that oil and then just resell it once the disruption is abated.
Okay, so as we move into the mailbag shortly, you said you're looking at an $85 price for oil, West Texas Intermediate. My question is, are you investing based on that? Are you looking for companies that do well in an $85 environment? Or are you erring on the side of conservative and you want to know, can they survive and maybe even thrive where oil prices are? Forget about where you think they should be.
Yeah, that's a great question, and it's sort of fun to be able to take that sort of macro hat and then apply it to the micro, analysis that we actually do in the investments we make. So we sort of have two perspectives on this. So one is we like to own companies for the most part that can do okay even at lower prices. But the reality is that in a cyclical industry, you want to, one, in my view, own companies that can survive and do okay in very low price environments. And oddly, we actually had almost no bankruptcies in our portfolio during COVID, even though prices went negative and prices were really low. The companies actually did fine. Weirdly, we had a couple after oil prices went over $100 a barrel and then came back. But generally, the companies, even when companies look sort of stressed from how investors traditionally look at them, the broad industry is actually delevered substantially. And so balance sheets look way better today than they did a decade ago, especially on the smaller cap side. So we're investing in companies that we think will do fine at $60 or $65 oil, $2.50, $3 gas. That should do extra well as oil prices go towards 100 plus, and as natural gas prices go to 4 plus an MCF in the US. And so I think it's sort of you want to make sure, I think, when you're investing in cyclicals, to actually own things that deliver enough of a return to make it worth having taken the risk and volatility and uncertainty. And I think that's sort of where we've done particularly well, is finding these points in the cycle where it makes sense to take that sort of extra risk and lean into companies that can do a lot better than most at, let's say, $100 oil. And to avoid sort of the trap of chasing into these larger cap, perceived lower risk companies right at the point where they've already outperformed and where there's actually extra risk in some cases, but not much extra potential return.
All right, well, let's get into the micro and talk about some of these stocks. Dip into the mailbag. Okay, we talked a little bit about M&A, and our first two questions are about companies that have either just done a deal or want to do a deal. The first one is on Whitecap. We actually got a couple of questions on this. One coming from Neil. Did Whitecap comment on a U.S. listing when you talked to them? I assume you met with the company. Should they have a U.S. listing? And then from Nugget Capital Partners, which we know are fans of the show, when will Whitecap cut the dividend? And I think that's a bit more of a spicier question. Whitecap, of course, recently purchased Varen, so they were consolidators in the space.
Yeah, so I had shared on social media, I had dinner with them. ATB brings down a number of different Canadian oil and gas companies to the U.S., to Houston in particular, a number of different times a year. And so had a dinner with them that ATB arranged. And I posted on social media. I thought it'd be interesting. I know it's a very heavily followed company by retail investors, and I thought people would be interested, and I thought maybe I could get some good questions to ask them and, give back a little. I appreciate getting to meet with these companies and hear their perspectives. And I think people also know that I am not a paid advocate of any of these things, so I'm happy to sort of ask the tough questions and then just share whatever. So I think those are two of the biggest questions around Whitecap right now, which bought Varen, which used to be Crescent Point, and then has been divesting some of their low decline oil assets in Saskatchewan, which Crescent Point Varen was also doing, and buying shale oriented Montney and Duvernay assets in Alberta. And so I have their answer, which is that they are not interested in a U.S. listing because it adds extra cost and doesn't add value for them, especially as they pay a dividend and buy back shares. And I disagreed with them, and my view was that having a U.S. listing would increase their addressable market for their shares by a lot. And to the extent that they ever plan on using their shares to do more acquisitions, it would make sense to me that they would spend the relatively small amount of money annually in order to be able to have the shot at having a much better valuation, which would potentially allow them to do more accretive deals. So reasonable people can disagree. And
although that didn't really work out for, I was going to say that didn't really work out for Varen.
That's true, but to be fair, and actually this is where Nugget's question is maybe more relevant than people would like to think. I mean, there were very aggressive stock promotion and other things going on with Varen and Crescent Point over, the whole history of that company, but particularly in the last year or so, very strange things going on with that. And when you look at it, both from what Whitecap has said about the guidance for Crescent Point Varen, as well as what the analysts are saying about it, I think Whitecap, they knew what was going on, but I don't think they understood quite how bad it was. A lot of those assets, the guidance on them was very, the analysts called it punchy. From American perspective, we'd use sort of harsher language maybe. And so, I think there's a real challenge there, but there's also an opportunity where, the Whitecap company and their management, they're excellent. And so, if there's anyone that's going to come in with an engineering perspective and sort of rework these assets and get their potential out of them, Whitecap guys are the right guys to do it. So I don't think they're likely to cut their dividend, at least anytime soon, at least anywhere close to current oil and gas prices. But we'll see. They acknowledge the risks and the challenges with the assets that they bought. And the flip side is they're excellent at it. And they've had some really, really good wells recently, particularly actually on the Whitecap side, the legacy Whitecap side. And so I think they have a good shot. I don't own the stock. I really like the people, and I wish them well.
Why don't you own it?
So it gets back to the valuation question, where I could own Whitecap stock or I could own other similar companies at a fraction of the valuation. And so in my assessment, it's not worth that extra risk and reduced potential return, even though, again, I think they're great at it. It's just a question of what's already priced in and then what the risks are and where I can earn the best risk-adjusted return for the capital, the scarce amount of capital that I'm able to deploy. And it just doesn't make sense to me, even though I like them and I like their prospects. The discount there, I think the market likes them too. So that being a consensus view and the valuation being relatively high versus some of these smaller cap companies I'm invested in and find more compelling, that's where my capital's going.
And we'll talk about those in pro picks, but I want to get to our second question, which is on, of course, the new shiny object, which is the Strathcona deal for MEG Energy. Last I checked, MEG is trading above Strathcona's offer price. And so everybody's thinking, oh my God, somebody else is going to come in and buy MEG. So this question is simple, from Dino Bambino Dean on X. What do you think of Strathcona Resources' offer for MEG? The market is telling you it was too low, but what do you think?
Yeah, so I'm not offering any sort of advice on whether people should tender their offers or tender their shares or anything like that, but just high level as a disinterested bystander. So first of all, what Waterous Energy Partners has done with their fund and aggregating assets has been phenomenal. It's really amazing to watch. I was on the other side of them owning Pipestone shares as they took under that asset. And it was sort of wild to see the governance failures and management failures of the Pipestone people and of that board. But good on Waterous to be able to capitalize on that and get control of it. They've done a number of great deals, but I think it's important to distinguish between getting great deals on lower quality assets and what MEG has done, which is almost the opposite, which is they spent a giant amount of money to develop out and took a lot of risk to develop out a truly world-class asset. And so I think it's been sort of not a fair representation that Strathcona's assets are the same as, or twins, or whatever the wording was with MEG's assets. I mean, just when you look at it on a metrics basis, it's just not true, at least as I see it. And so, I think on one hand, Strathcona has done great, and I would expect they would continue to do great. And even just buying the stock and then making the offer is way smarter than what most people do. So good on them to actually be careful with their capital and careful with the shareholders' capital. And if they're going to go make a premium offer, go buy stock ahead of it. On the other hand, that doesn't necessarily mean that
either way they win, I guess, right?
Sorry, what's that?
I said either way they win, right? Because if somebody else comes out, well, they own 10%.
Yeah, exactly. So again, very smart, but that doesn't mean that Whitecap shareholders should necessarily accept it, that MEG shareholders should accept it. And we'll see in terms of how it plays out. I mean, you could see MEG getting a premium, although MEG actually is trading at a reasonably high price. They effectively reduced their debt that they had taken on to develop out their asset, and they've been buying back shares, which has sort of propped up their valuation. And so, I think it's a complicated situation. I don't know whether another offer comes in. I'm not sure that it's better for MEG shareholders to tender to Strathcona. It may be because Strathcona and Waterous have done so well for their shareholders. It may be that it's better for MEG shareholders, even though their asset is better on the metrics, to sell and take shares, because who knows what Strathcona will do next. Or it may be better for them not to tender and just to keep buying back stock and hang on. And there may or may not be a higher bid for those assets. So we'll see. It's very interesting, and you can sort of like these things, or like these teams, or like what they're doing, but also not want to own them at high valuations with lots of overhang and risk and so on. So I think that's sort of where I sit with my popcorn popped, watching to see how this all plays out.
Well, then let's do a little bit of fan fiction and see who makes sense as a potential white knight acquirer. A lot of people think Cenovus, but then a Cenovus executive said, we're not really focused on M&A right now, and seemed to throw cold water on that notion. Other people have thrown out Imperial as a potential buyer. Do you have any thoughts on who steps in?
Well, if no one else steps in, I could actually see Canadian Natural Resources stepping in, because Murray Edwards is a fan of buying things at a discount. Sort of, he's, I think Strathcona is trying to follow to some extent the Canadian Natural Resources playbook from way back when, and so I think they are well positioned to do that. And if I had to bet on one of them doing it, that might be the one. Another possibility would be Suncor, which their CEO, brought in by an activist, has just done an extraordinarily good job turning around that company, and they actually have a pretty good valuation and some resource, remaining resource questions and issues, and so it's possible Suncor could come in and buy it too. But again, what do I know? I don't know that anyone really knows who will buy this, if at all. And I would push back on the Cenovus thing. Frankly, their refining assets have underperformed. Their upstream assets have done well because they're such high quality, but Cenovus has massively underperformed versus its peers. So I would question what they're focused on broadly, if they're not able to go look at and try to figure out how to buy this adjacent, highly synergistic asset. I'm not saying they should buy MEG, but if they're not able to focus on that, when you look at the fundamentals there, I think there are more questions than answers. And frankly, I wouldn't be too surprised if an activist got involved there at some point, given the massive underperformance versus their comps, again, purely on a share price perspective, as well as on financial metrics. And when you look at how well Suncor has done after an activist got involved with, frankly, similar issues to Cenovus. Suncor's were on the upstream side, Cenovus is on more the refining side. But after that prove out, would not be surprising to me to see that sort of interest and change potentially at Cenovus.
That's interesting. So we actually got a question on it from the poor Oracle on X. What are your thoughts on the long-term price for Cenovus? And you basically say that they need a shakeup, and activists potentially could step in here.
Yeah. And again, I think I would have thought prior to Elliott management getting involved with Suncor that maybe Cenovus would be too big and too complicated for a US activist or, someone else to come in. And I would say at this point, Elliott has shown definitively that they were able to come in and with the former CEO of Imperial come in and just really clean house and fix it and change. I mean, it's like, imagining the biggest cruise liner in the world and then bigger and having it do like a 180 real fast. And so that's obviously extremely challenging, and they were able to do it. So I think that's probably going to inspire a lot of activism, even on the large side, on companies like Cenovus that have underperformed their peers. Again, superficially, you can just see how their shares have done versus their peers in the last few years. And I think that's generally the starting point for activist investors.
So this leads us beautifully to our next question, which is the choice between Suncor and CNQ. Could you ask Josh about Suncor versus CNQ? If you had to pick one, which one would it be and why? This one coming from KK Investing on X.
That's a great question. I don't own either because, again, I just see this asymmetry on these large caps that are trading at these much higher valuations on book value and replacement cost and EBITDA and so on. I just see them being not overvalued, but way less attractively valued versus the smaller caps that in some cases have very similar assets. That being said, I think Canadian Natural Resources is probably more interesting here just because Suncor has been a great turnaround, but there was arguably a lot of low-hanging fruit for the activists to address. And there are some long-term problems that Suncor still needs to address, like replacing their reserves. And they have some mine life questions and issues on some of their core assets. Canadian Natural Resources, much less so. They've done a good job of replenishing their reserves, and they just have this culture that's so impressive. And actually, one of the top picks, we're going to talk about this, where I think there's a similarity in that culture elsewhere and in that ownership and approach that's totally unloved and no one even really pays attention to. But I think that culture is somewhat unique. And Murray Edwards has created just a giant amount of value for shareholders in the multiple companies he's involved in. And so between the two of them, I think, again, I don't own either, but I think just that long-term capital allocation and execution track record at CNQ is unmatched and is easy to prefer even versus sort of a newly improved Suncor.
It's interesting. You talked about CNQ stepping in for MEG, and I read a report, I think it was from RBC, said CNQ is busy kind of deleveraging their balance sheet because they bought this. They bought Chevron's 20% stake in the Athabasca oil sands project, and so they're working through that as a business. Do you think that it precludes them from MEG, or that you could see CNQ still stepping in for MEG, even with having purchased that 20% stake from Chevron, or Chevron's 20% stake?
Yeah, I mean, honestly, like if CNQ wanted to, they could easily. Will they? I don't know. That was more sort of the like pop the popcorn, try to figure out what the speculative buy or whatever would be. But I'm not saying they will. I'm just saying they could. And again, they would only do it if it made a lot of financial and operational sense for them. And the company for whom it would make the most operational sense is Cenovus. And this is a real cautionary tale where I was an activist. I did actually get control of a small publicly traded Canadian oil company in 2017. And I did that partly after they did an asset sale at Ante Creek. And there was a larger company active in Ante Creek that could have bought that asset just for the infrastructure and paid twice or so the purchase price just to avoid that capital spend just on infrastructure, and they didn't. And it was hard to tell if the potential buyer was just grossly mismanaged or if the sellers didn't do a good job with it, or both. But from a seller's perspective, it just made sense to come in and try to refocus the company and make sure that whatever remaining assets were sold at a reasonable value. And, I look at Cenovus right now with this MEG situation, and again, it just has a lot of parallels to that sort of foregone opportunity. And again, should they buy MEG? It's hard because their valuation is low, but their valuation is low because they're mismanaging or have had issues with their refining assets. So, real sort of mess and mixed, complicated problem. But in the end, I guess I don't want to be the one to tell Canadian Natural Resources they should or shouldn't do almost anything. They've done such a great job over such a long period of time. And again, they're actually one of the reference points I see where they came in and paid a price that I think people had trouble understanding on buying that big set of assets from Chevron. And I look to them and say, hey, they're going and buying oil assets at relatively high valuations. That's probably a good signal that oil assets are compelling here. And if I can go buy smaller assets at way lower valuations, then maybe I can do even better and more similar to what Canadian Natural Resources did 30 years ago versus what they're doing today.
That company was RMP, right?
That's right.
In 2017? Yeah, and you sold it for a nice premium after a lot of suffering, which should be noted, leading into that. But I guess that created the opportunity for you to step in. Okay, we got to take a quick break. We've got a couple more questions before we get into your pro picks. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, let's get back to the mailbag. I want to squeeze in these last two questions. One is on Baytex. You can almost hear the helplessness in this poor viewer. Will Baytex ever recover? Thanks from Big Linford on X. I mean, really disappointing performance by this energy company. What do you think?
Yeah, so we were massively bullish on Baytex on their discovery of the Peavine, essentially Clearwater analog in 2021 and bought a ton of the stock in the low ones, published articles about it, talked about it on TV. And then when their improvement trajectory slowed, and it looked like they had mostly developed the field. It's not fully developed, but it was mostly developed and the wells stopped improving by as much as they had been. We sold and posted on social media, hey, we're out and here it's up, I don't know, it was like 4x or something from where we first shared our position. And I think Baytex has been in a very tough position. I think they get hit publicly for things that I don't know that I would really blame them for. And then they have problems that I think people don't really appreciate. So, or maybe they appreciate them now, but didn't appreciate them then. So the biggest problem they have is that they were sort of supporting the valuation of this whole pretty big company off of this relatively small heavy oil field with spectacular results, but relatively small. And so there wasn't enough of a effort to sort of replace reserves or to get into more fields that were similar. And so when they depleted that sort of the low-hanging fruit on that field, and they hadn't replaced it with many more heavy oil fields with similar extraordinary economics, it was clear to me that their capital efficiency was going to fall a lot. And when you have to spend 3 times as much money to get the same amount of oil, your stock price is likely to fall, not rise. And so that was the thesis on selling, and they went and bought an Eagle Ford asset, which people don't like, but actually it's not a bad asset. The problem is just that the capital efficiency fell. I think at higher oil prices, Baytex could work really well, but it also has a lot of risk here. And so not involved here, could potentially get involved at some point. But right here, right now, I think they're still dealing with that issue. And I don't know, maybe an activist gets involved there and tries to push the company to split between a US and Canadian company, or maybe they go and find another set of assets or some other thing to do. But we're not involved anymore. And we lost interest specifically because they had this extraordinary find. They were extremely well managed, really focused on it. And then when there wasn't that backfill and new management came in with a different plan, it didn't make sense to stick around.
Are you still in Sandridge? This is our final question in the mailbag. This one coming from Panda on X. Are you still a believer? The stock has kind of been just melting lower for the last year or two.
Yeah, so we still own some. It's paid giant dividends. And again, this is one of those where we're really excited about it at like $1. I think we put out an article at $1.60 or $1.70 a share in 2020 on it. And I don't think I've ever gotten as much hate as for putting out something positive on Sandridge. They were at one point $10+ billion enterprise value, and then they went bankrupt, and they kept the same name coming out. And so I think people still associate the current entity with the pre-bankruptcy entity, which has different management and a different board. And then subsequently, Carl Icahn got control and put one of his former investment analysts in as the CFO, which is strange and sort of out of place, odd sort of philosophy or setup. And they haven't really done. They bought an asset. They're addressing it. They've started buying back stock. So, it's fine. It's very cheap. It's not nearly as cheap, obviously, as it was at close to a tenth the price. So we like it, but, a lot less at at 10 and change than we did at $1.70.
So you're hanging on to it, maybe not buying more, and Icahn is about a 13% shareholder.
Yeah.
Okay, now it's time for Josh Young's Pro Picks. ProPix is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Josh, you have to answer for this one. Your first pro pick is Journey Energy, Joy on the TSX. And really, it's been anything but as a shareholder. It has just constantly grinded lower. We got a lot of questions on this, including from Randy on X. Why did you go active on Joy? And what do you hope to accomplish now? So you're not somebody who's sanguine, I guess, about how much of an underperformer Journey has been, but you're still around in this name and you think there's value to be unlocked. Take me through your thinking.
Yeah, I mean, this is one of those where the management team had a great track record coming into it, and they had a set of really tough assets to start, and they did a good job, in my view, over the first few years of trading out of underperforming assets and into assets with a lot of promise. And when we had that hostile bid for Iron Bridge, which was the renamed RMP, we had been pushing pretty aggressively towards building out power generation, hosting Bitcoin mining, and just generally improving economics on gas assets that we had that were net negative, essentially, because between the low gas price and then the processing and transport costs, there was this big opportunity. So we went and pushed pretty hard on a couple of other companies that we invested in, including Journey, which we were the, I think, largest shareholder in at the time, to go do power generation build out, and then also to accelerate their Duvernay shale project. And so as they worked towards that, oil prices collapsed during COVID, and they were able to restructure their debt, which was good. But the difference in trajectory for the company, sort of pre-COVID and in the first little bit after COVID, versus what we saw later, was really disappointing. It sort of looks like they, I don't want to speculate on what happened exactly, but there is sort of a measurable difference. And in the last few years, their capital efficiency has fallen. There have been huge delays on these power projects that, frankly, they were so early on that there should not have been these sorts of delays. Now there's lots of gas projects with cost overruns and delays, but 3 years ago, that was not really an issue. And these things should have come on. And we put out analysis. We actually can't find where all the money went, which is a real concern. And and haven't put out publicly thought there would be a response, and just silence, which is again like really sort of odd for a public company to just sort of ignore.
So
and then
I mean,
yeah.
that's Well, I was just going to say, like, that's normally we don't hear about this for somebody who's like, this is my top investment idea. So, like, why don't you just sell it and walk away? Why are you still in this name? And what do you think can be unlocked?
Well, let me share one more risk, and then I'll tell you why we've been buying more of it. So the one more risk is that the chairman was the CEO of Zargon, which was overpromising and had similar cost overrun issues and collapsed and went bankrupt. And so, so why are we still in the name?
You are not selling this, Josh.
Sorry, what's that?
Said you are not selling this, Josh.
I'm not. Okay, so why are we in the name? So one, there was a management shakeup at AIMCO, or at least a board shakeup at AIMCO. And their board was replaced because they were spending too much and getting too little. And it appears that AIMCO has been supportive of Journey's management and board so far publicly, which is a very big difference from what's happened actually at AIMCO. And now there's this whole national conversation in Canada about pension funds and where does Alberta fit in and so on. And I think there will be a lot more changes at AIMCO probably soon. And I think that may shift to a very different governance approach for their local investments, particularly Journey, which has so many similarities to AIMCO itself in terms of the governance and management and compensation and so on. So one, I think there's without our involvement at all, I think there's already this impetus towards AIMCO portfolio positions and towards their management style. Frankly, it's surprising that there hasn't been more change, I think, at the staff level for AIMCO. But typically, it's similar to Suncor, where Rich Kruger comes in and has a mandate for change, and you'll have a little while where some of the same people are there and some of the same bad stuff happens, and then you see radical change that's substantial. And I'm optimistic for AIMCO that changes, and I think that may lead to substantial positive changes at Journey for their board and management.
And how much can? Well, I was just going to say, how much can be unlocked?
Yeah, so that's the real story, right? So the conventional assets have hundreds of millions of barrels of recoverable potential reserves, which is phenomenal. And when you look at the history of low decline oil assets and low decline gas assets, those get very high valuations in high points of cycles and very low valuations and low points of cycles. And so just those conventional assets could be worth 5 or 10 times where the shares are trading today, just in a higher price environment. So that's sort of that right tail upside. But then you have the power gen, which should eventually come on. And as that eventually comes on, that could be worth roughly the entire market capitalization currently. And then you have their Duvernay, where they're in with the Spartan guys who are brilliant and have done extraordinarily well and created huge value for their shareholders over many entities. And that value creation is already happening where you asked about Baytex before. The difference in between well results for Baytex and very close, the well results for Spartan, is night and day, and the Spartan wells keep getting better and better. So just the Duvernay asset over time could actually be worth as much as the market cap too. So you have this just enormous potential value and potentially actually enormous current liquidation value stuck in this legacy sort of governance mess, tied into this Alberta pension governance mess. But the Alberta pension governance mess is getting fixed, and I think that flows down. And again, independent of our involvement or sort of identifying some of these issues publicly, I think this would already sort of take care of itself to some extent. And I think if that could get accelerated a little bit, that would be wonderful.
Okay, so let's go to your second pick, maybe a little less complicated story, but certainly the stock has underperformed, and that's Ensign Energy Services, ticker ESI. It's down, and I think there's some concerns about deleveraging, their ability to pay down debt. Talk to me about why you like this one. It's a driller.
Yeah, it's a drilling rig company. So this one is really simple. So it's over 30% owned by Murray Edwards, who I have nothing but good things to say about, and who is enormously rewarded in the public markets across, at this point, virtually every other public entity that he controls other than Ensign. And so for anyone that says, hey, Canadian Natural Resources is such a great company and so well managed, and look at Murray Edwards, he's so great, and look at this approach towards managing a company, I would say, hey, you could buy Canadian Natural Resources at what, 7 times EBITDA, and low teens or high single digit free cash flow yield, and roughly in line with their replacement cost. Or you can buy Ensign at a 30 or 40 or more percent free cash flow yield to the equity, and at what is it, like a third of book value and a fifth or a seventh of replacement cost. And they've paid down more debt in the last 3.5 years than they have in market cap right now. So I think people just don't look at it because they think of it in the back of their mind as an over-levered company, even though they've been extremely successful in rapidly delevering. And people hate drilling rigs, and they don't like companies they perceive as over-levered. And they look at the stock price and say, hey, this hasn't gone anywhere, and there's no buybacks because they're paying off debt. And yet, here you have a Murray Edwards controlled entity, and the number 2 shareholder is Fairfax, and they've actually increased their position a lot recently too. And that's sort of the Canadian Berkshire Hathaway, arguably better, right? They've done a lot better than Berkshire in the last 5 years. And so between them, I think the joke is actually for Ensign that all it's going to take is someone getting on, BNN or CNBC or something and clicking their heels 3 times and saying Murray Edwards, Murray Edwards, Murray Edwards, and the stock will skyrocket as they rediscover that this thing exists at this tiny fraction of where Canadian Natural Resources trades. So that's the joke. We'll see what happens with it. And I guess just the last thing, just mechanically, mathematically, and theoretically, as the company goes and delevers, even if it pays off debt slower and goes to, let's say, $150 million a year of debt pay down instead of 200 because of the slowdown in the drilling rig business, and even if there isn't a big recovery in commodity prices or whatever, that $150 million a year in debt pay down translates to somewhere around 50 cents per share of essentially market cap equivalent for a roughly $2 a share stock. And so just the debt pay down should unlock at least 50 cents a share in value every year. But then as it progresses, one, there's more free cash because there's less interest paid to be able to buy back more stock or pay down even more debt. And then 2, it gets less levered, but it doesn't reduce its intrinsic value. Like that replacement cost measure is still there. They're maintaining their rigs. They're maintaining their ability to generate cash flow. So, really interesting sort of mathematically and sort of a deep value, very easy to own company with a lot of asymmetric upside and a lot of asset value protecting the downside. And then you have this just right tail potential, which is the market wakes up one day and says, hey, let's not pay 7 times EBITDA for a Murray Edwards entity, or 10 times like his copper miner, or I don't know how much for his space company. Let's go buy this driller at under 3 times EBITDA and at less than, what is it, like 1 times price to cash flow. So I think there is that real right tail potential.
Well, you did click your heels 3 times on In the Money, so we'll see what our power is at the end of this podcast. And you're right, Murray Edwards and Prem Watson's Fairfax, they own about 40% of this company, a little bit more than 40%. But come down to fundamentals, and you said everyone hates drillers. It's because, as you said earlier in the podcast, what's the cure for low prices? It's low prices. And how do you get there? You stop your activity, right? So if production activity is going to be lower, drilling activity is going to be lower, what's to get excited about the actual business, not the multiple, not who owns it, the actual business of Ensign?
Yeah, I mean, that's a great question. I think that's the problem sort of across the land drilling rig space. So there's 2 things. One, we're probably closer to the bottom than the top in terms of the global rig count, as well as the domestic US and Canadian rig count. When you look at past cycles and you look at sort of how low things have gone, and you look at drilling rig efficiencies and so on, it doesn't look very likely that we go down very much more. The current activity level in oil and gas in the US is low enough that we're already seeing some production declines based on real-time data versus the start of the year. We're down roughly a few 100,000 barrels a day for crude oil. It's not in the EIA weekly numbers, but you're starting to see it in some of the satellite data and some of the other the other data, and so we'll see. Like, it's possible that gets revised up, but we're seeing production start to decline. We're seeing more and more demand for natural gas, especially in the U.S., but also in Canada, and so. I think we're sort of hitting that tail end of drilling efficiencies just as is. As prices eventually rebound, and this one might be a little more tied, let's say the upside prospects for the business might be more tied to potential recovery in oil and strength in natural gas. But as we see that, we could see the drilling rig count rebound pretty substantially, and Ensign would be one of the biggest beneficiaries of that because of their financial and operating leverage. So I think I don't know if we've bottomed from a drilling rig perspective, but we're getting close. And I think importantly, these guys have paid off so much debt in the last few years that while the market might view them as having some sort of debt issue, I'd imagine at their lenders, they're a hero for, paying high interest, but also having paid off $600 million of debt in the last few years. And when you pay off that much debt, you become a very high value borrower, and you buy yourself a lot of room to be able to extend for quite a bit of time. So I don't see there being a real debt issue. And if anything, maybe they just move, like I was referencing, from paying off $200 million of debt a year to 150 or something, which is still a huge amount of debt relative to their market cap and relative to their overall debt level.
Okay, let's get to your third pick. It's Vital Energy, and you're consistent. This is another beaten up name. It's down 50% in 2025, ticker VTLE on the New York Stock Exchange. Why do you like it?
Yeah, so they did a number of acquisitions countercyclically. They bought assets that people didn't like that were relatively high cost, and people didn't stick around to see what would happen and sold them off. And then at the start of the year, they did some exploration that was unsuccessful. And I think people took the cost from that exploration and applied it to their development, I think incorrectly. And when you have a stock sell off, I think the presumption is or the general market behavior is to shoot first and ask questions later. So it's been very interesting because we've gotten to buy more of the stock at a really low price, where the operations have actually improved dramatically. And the valuation is just wild here. But people got sort of distracted by this poor exploration effort and this poor result. So as these operations continue to do well, we think that the stock will start to reflect that. And this thing is wildly inexpensive versus its comps and could trade up multiple times just to trade in line with some of the other small to medium-sized publicly traded Permian producers.
Okay, Josh, it has been an absolute pleasure speaking with you. Thank you so much for joining us on the podcast. That's Josh Young of Bison Interests joining me. Make sure you stay tuned to our next episode. We've got Daniel Lewis on the show of Orange Capital. He's really interesting. He really finds himself in these special situations and distressed assets. If you've got one of those in your portfolio, send us an email. You can email us at questions@inthemoneypod.com or hit us up anywhere on social media. He's, I'm sure, got a lot of war stories out there about Canadian stocks that he's been in. So it's going to be great storytelling. And we'll catch you on the next episode of In the Money with Amber Kanwar.